Okay, all right. You cannot see the screen. One second, let me share the screen. We will be doing chapter 2 and chapter 3. Inshallah, let's start. Bismillah ar-Rahman ar-Rahim. Oh, and also, like, oh, wait, no, I think I can just put it from here. Yeah, very cool. Okay, perfect. So we stopped here. We finished some questions. We did not do this part because it would be too long. And if any one of you wants to do it, you can just do it. And then if there's any problem, then you can send it in the chat, like on the IGCC accounting chat, and then I'll answer it, or anybody, any other helper. All right, chapter 2, double entry bookkeeping. This is your normal bookkeeping, which was recording day-to-day transactions, but instead of just recording it in one place, you have to do double entry. Now, what exactly is that? Let's just say that you pay money to somebody. So now the double entry would be the money account and the somebody account. Okay, so you have to enter the transaction twice. All right, let's look at the proper definition. Double entry bookkeeping is the process of making a debit entry and a credit entry. Now, what's debit and what's credit? These are the two sides of a T account. Okay, a T account. One second, I put it here. Debit side and the credit side. Debit side is the left side and the credit side is the right side. In our first chapter, we read that the debit side is the side that. One second, where is it? Did we read it? I don't think we read it. Yo, was good, bro? Oh, you're here. Let's go. All right. We just started like right now, 2 minutes ago. One second. I don't see it, bro. It was written about debits and credits, okay? So it would tell us what debit is. I think it's in this chapter. All right, let's continue. Yeah. So the T account or the ledger account is something like this. Like, in your exams or in your normal notebook, you're going to draw it something like this. This will be the debit side and this will be the credit side, as you can see over here. And then you're going to have to write the account name in the middle. All right. Okay. The term double entry because there's two effects of a transaction, a giving and a receiving. Okay. Now there will be different accounts for each type of asset, expense, and liability. Now, what do you mean by each type of asset? There's two types of assets. There's what current assets and there's non-current assets. There's like your machinery and stuff, and there's your cash and bank and stuff. And expense, you don't just make one expense account where you put all your rent and electricity and utility and everything. You have different expense accounts for like every single thing. Okay. So if you have a look down below, they have somewhere over here, you see, rent payable account, insurance account, motor expense account. So each of them has a separate account. All right, we'll look into it further. Okay, liability is something we owe, and that also each one of them will have a different account. They have here they have Malika loan account, so we take loan from this person and we make a different account for them. This person is a liability to us. All right, this account or whatever. Now, a ledger normally in the old times would be something, a book or something, all right? But now it's, just computer. It's like everything is in the computer, okay? This is our introduction of a computer file divided into separate ledger accounts. So if you actually look at accounting in businesses and firms and like you could say if you go to a shop and tell the person to show me your accounting records, it won't be anything like this. It's gonna be a bit way more professional and you might not even be able to understand it. But we need to understand this because this is the basic, okay? So like this will help you understand that. And you will learn the computer accounting and everything in like AS or A levels. And it's also in the new syllabus. Anyway, back to the topic. So this is the debit side, the left side, and this is the credit side, the right side. The reason why we have double entry is because there's a giving and a receiving. And now let's look at debit and credit. Ledger accounts are divided into two sections. First section and second section can be shown by a central vertical line, something like this. And the vertical line is not shown because, it's just a textbook. I mean, probably looks better this way. The left-hand side is known as the debit side and the right-hand side is known as the credit side. The term debit, instead of writing debit completely, you just write DR, okay? Now, if you ask me, it's not really important, but like debit has no R, okay? The reason why we write DR is because like it's a short form of debtors. Okay, yeah, but it's not important. So DR is the short form. Instead of writing debit, you're gonna write DR. If you look at the next examples, yeah, they didn't write it at all. Because in your exam, you don't have to write debit and credit. It's common sense, okay? So like over here, debit, over here, credit, you don't need to write that. All right, you don't see it in any account unless they're like introducing the concept. Okay, all right. On the other side, there are columns to record the date and the amount and folio. This is just something you need to know. It's not like you don't have to do it in your exam paper, and it's not part of syllabus. Like you don't have to use it. You just have to know what it is. And it's kind of a reference, okay? So if we have a look here, this is our bank account, okay? This is capital and the folio is 2. So if we go to, this is, let's just say, our first book, and this is our second, and this is our third. If you go to 2, you will see here folio is 1. So it's just reference to, like, connect the double entry to show where the double entry is. So like this is bank account and capital is on the debit side. If you want to show, if you want to see where the double entry is, so you just go to folio. This is the second book. You go here and you get bank. Okay. So like in our exam so far, it's not important. All right, a folio column is used for reference. The folio number is not required when answering questions. Folio have been included in examples up to chapter 7, so you can understand what exactly they do. All right, now to record the two aspects. What do you mean by two aspects? The two sides of a transaction, right? The giving side and the receiving side. What do we have to do? You have to record it twice on the debit side of one account and the credit side of another account. Now let's see an example. Ajay began business. He opened a business bank account and invested 80,000 as capital. What are the two accounts over here? The first account is a business bank account, and the second account is the capital account. Which account is giving the money and which account is receiving the money? He opened a business bank account and invested 80,000 as capital. The bank account is giving money to the capital account, right? So what do we see here? Did they tell anything about how to record the entry? Not yet. Okay, yeah, okay. The account which is receiving or gaining the value is debited, and the account, a second, yeah, receiving or gaining the value is debited, and the account giving the value is credited. What's happening here? The bank account is giving money to the capital account. When you invest money as capital, your total bank balance reduces, your capital increases, right? Since this is his own money, his capital will increase. So what's going to happen to the capital account? It will be credited. Why? Because, oh, wait 1 second. Yeah, the bank account debited, the capital account will be credited. Yes. All right. So the capital account giving the value. Okay, I don't think I should confuse this with capital account. The reason is that the accounting equation. I think I'll explain this later. Let's just look at the next example. Capital is a bit confusing because it is credit positive. Fixtures and equipment costing 30,000. Fixtures and equipment is an asset. You have a different account for each asset. Okay. So you're gonna have a fixtures and equipment account costing 30,000 were bought and paid for by check. When you see check, it means that paid for by bank, right? All right, so you have your bank account as well. Now, who's giving the money and who's receiving the money? The bank account is giving the money to fixtures account, right? The fixtures, you're gaining fixtures, you're getting fixtures. Your fixtures, your total balance over here is 0, but it's increasing. So you debit the account. The side which is receiving or gaining is debited. So right now we bought for 30,000. So you're gonna write here 30,000. And who is giving the money? Who is giving the value? The bank account. So you're gonna credit the bank account by 30,000. Okay. And this is the concept of double entry. So over here you can write fixtures and what is it, fixtures and equipment, and here you can write bank. And what date will we write? You're going to write January 2, and same thing here, you're going to write January 2, and you also have to write the year. Now let's look at the example here. Fixtures and equipment, I have 2007 Jan 2, bank $30,000. And if you look at the folio, it's 1, you go to 1, you go to your bank account, and you have fixtures and fittings on the credit side of the bank account. Why credit side? Because the bank balance is reducing. The bank is giving the value to who? To fixtures. The value inside fixtures, the total value, it was 0 before, it became 30,000. Now it's increasing. That's why you debit the account. All right, that's what this statement here means. Very important statement. It's going to help you a lot in the future, probably, if you're new to accounting. Okay, moving on. This is the explanation of this example here, and I explained it, so I guess everybody understands it. It's important to ensure that every transaction is entered twice, once on the debit side and once on the credit side. Because if you don't do this, in the end, when you're like making your financial statements, when you're making your balance sheet or income statement, you won't have proper balances. Okay, and it like the reason why double entry is important, the what do you call it? The benefits of double entry, none of them will be there because you're not doing double entry at all. Okay. Uh, in practice, as in like in real businesses. Okay. Okay. Explain why it is necessary to make a double entry in the ledger for each transaction. The answer to this is written over here. And then explain the use of folio column. It's just this place. All right. Moving on. Double entry records for assets and liabilities. What did we do here? We just did like normal introduction to double entry. Okay. Now we're gonna go for assets specifically, and then we're gonna go for expenses and income specifically. All right. And then drawings. We'll go through that. Okay. So assets and liabilities right here. A ledger account is open for each asset, each type of asset, which would be like your cash, bank, fixtures and equipment, anything, and liability, the amount you're owing to anybody, can be anybody. Applying the double entry principles, every transaction is entered twice, once on the debit and once on the credit. Okay. Again, they're just saying this multiple times so you don't forget it. The receiving side is debited and the giving side is credited. Okay. So you credit the giver and you debit the receiver. All right, let's look at the example. Ajay began business, opened with 80,000 as capital. What happens? The bank account increases by 80,000. And what caused it to increase? The capital caused the bank account to increase. Okay. So the bank account increases, the value in the bank account increases, and that's why we debit it. The amount which is receiving the money is debited. The account receiving the money is debited, and the account giving the money is credited. You're getting the money from your capital, and that's why you credit your capital. All right. Second. Okay. Fixtures and equipment, 30,000 were bought and paid for check. Your total bank balance reduces. You put fixtures and fittings here for 30,000. You go to fixtures and fittings account. Your total fixtures and fittings increases. Sorry, fixtures and equipment. And that's 30,000 over here on the debit side. What's causing it to increase? Your bank is causing it to increase. Oops. All right. Next, a short-term loan was received from AB Loans. What's happening here? Where are we receiving the loan? We're getting this money in terms of money, right? We're getting it in our bank account. So our bank balance increases. We record it on the debit side of the bank account. And what's causing it to increase? AB Loans. So we go to AB Loans account and we credit the account. Okay, AB Loans is giving the money. AB Loans is giving the money, and that's why we credit the giver. All right, very simple. A motor vehicle costing 9,000 was bought and paid for by check, which means by bank. So your total bank balance is decreasing, 9,000 over here, and your motor vehicles are increasing. So you're going to debit that account. It's increasing because of your bank. Okay, by 9,000 and the date and folio, you understand it. All right, lastly, a long-term loan. Long-term loan means that this loan will be repaid after 1 year, okay? A short-term loan means that it has to be repaid within this year. So like, let's just say they bought it on January 6th, right? They took this loan on January 6th. Now this loan will have to be repaid 2008, January 6th. Any date after that, you can repay the loan, but any date before that, you can't, okay? It lasts more than 1 year. If it's lasting less than 1 year, it's going to be short-term loan. All right, double entry for expense and income. We won't go as deeply, but we'll just, go through it. Began business, it's again repeating. Paid rent for premises. So he paid rent using bank, using check. Okay, so what happens to his bank account? It decreases. The total amount in your bank balance decreases. If we look at bank and cash, we can just write here plus and minus, right? Because that's what's happening. Every time your bank account increases, your bank balance increases, you record it on the debit side, and every time your bank balance decreases, you record it on the credit side. So when we have bank account, can we simply just write plus and minus to like help us understand? We can. All right, no problem. Goodbye. So we're just gonna write plus and minus. What's happening here? Paid rent for premises 400 by check, so you're gonna write 400 here. What's causing it? Rent is causing it. So when you make your rent account, you're gonna have your bank on the debit side, and this is double entry. So this is the credit side and this is the debit side. If it's on the credit side of bank account, it has to be on the debit side of rent account. Okay, so like this is the concept that, let's just say you only know one entry. If you only know that, oh yeah, it will definitely be credited to the bank account, but you don't know what's going to happen to the rent account, then it will of course be debited to the rent account. Okay, it's always going to be the opposite. Fixtures were bought and paid for by check, 30,000. Paid insurance, again by check, it's reducing your total bank balance to 50. Short-term loan was received, 10,000, it's increasing your bank balance. Motor vehicle was bought, so you're reducing your bank balance, 9,000. And paid motor expenses, 50, it's again reducing your bank balance. A long-term loan was received, so you're increasing your bank balance. Part of the premises were rented out to another business, and a check for 95 was received. So you're getting 95 in your bank account. Okay, now let's check, and everything is correct. Oops, I forgot the 80,000. All right, so everything else is perfect. Okay, now all these accounts here, it's very simple to understand them. Like there's nothing complex about them. Okay, if you see your bank account is credited with rent, so your rent account will be debited with bank. See, this is the debit side, and there's bank over here. Again, next thing, if you see your fixtures and equipment credited in the bank account, your bank account is credited with fixtures and equipment, then your fixtures and equipment account is debited with your bank. Okay, and the same thing applies for all of them. Insurance is on the credit side of your bank account, so on your insurance account, bank will be on the debit side. Okay, very simple. I think we can move on then. Sounds pretty easy. When an item such as rent is both paid and received, separate accounts are maintained. You see here they have a rent receivable account. Now instead of making only rent account, you have a rent payable where you pay money to somebody and this is an expense, and you have rent receivable where you receive money by giving rent. So this is of course an income. All right. Now you see there's a difference, right? Why is there a difference? In your bank account, you receive money, so it comes on the debit side, and that's why in your rent account, bank will come on the credit side. Okay, normally when it was an expense accounts were being debited, but since this is an income, it's gonna be credited. All right, and I explained why. It's because of this. All right, so state the name of the account which will be debited and the amount which will be credited. Paid rates by check, your bank is decreasing, your bank will be credited. Credit the giver and debit the receiver. Your rates are getting the money. Credit bank. I'll just write short forms, I guess. Oh yeah, it's okay, no need to write them. Bought machinery and paid by check, your bank balance reduces, so you credit your bank, and your machinery increases, so you debit your machinery. All right, received commission by check, received commission. So you're receiving money, your bank balance is increasing, you're gonna debit your bank, and you're gonna credit your other business. So whatever the name of the business is, XYZ, whatever. Okay. Repaid, money borrowed. So your total bank balance is reducing. You're going to have to credit your bank account, and the amount you owe to this guy is increasing. But let's just not go there. Let's just like understand it based on our concept of double entry, right? Now I know that bank is being credited. So whatever else there is, it's going to be automatically debited. You don't really need to think much about it at this stage. But once you go deeper into the subject, you need to know why everything's happening. Double entry for drawings. What's drawings? It's a new term, but it's very simple. Let's just say you are a businessman and you have a supermarket. Okay. Now you go home and your mom asks you that she wants milk from the supermarket. So you go like, okay, I have a supermarket. I'll just go get my own milk and I'll bring it home. So you take that from your supermarket and you take it home. Do you pay yourself? You don't really pay yourself because like it's your shop, right? You just take it and you go home, but you record this somewhere, and this is called drawings. Okay, you record this in your drawings account. Drawings represent any value taken from the business. Now any value means that it can be in the form of money or in the form of goods. Okay, or like literally anything. Let's just say you have a furniture in your business office and you're like, okay, I like this, I'll take it home. You can, but you're gonna have to record it. Okay, any value taken from the business by the owner of that business. So if I'm the owner and I take anything from my business, it's going to be drawings. All right. A balance on a ledger account is the difference between the debit side and credit side. We'll look into this later. they have an example given here. It's a different thing. Okay, now whenever the business takes value, one second. We all know what capital is, right? Capital is the amount you invest into your business. So any money you put into the business is capital, and any money you take out from the business is drawings, right? Now, does that mean that, for example, in my capital account, if I had 80,000 here and I make drawings, so like let's just say I take 40,000, should I record it over here on the capital account? Because that would reduce the value. Normally, yes, that wouldn't be wrong, but the reason we do it, we do not like do it in the capital account when we make a separate drawings account, is because so that the capital account does not have a large number of entries, okay? Because if you keep taking drawings and you keep recording it in your capital account will be huge. You won't be able to actually see the capital you invested. That's why capital account is mostly not crowded at all. You only put final, like your final profit or your final total drawings or something like that. Okay. Anyway, any drawings are debited in the drawings account to show the value going into that account. Okay. So let's just say that I took money from my bank account and put it into my drawings account. Yes, it can. But instead of writing inventory, you will write purchases. I think they have an example as well. Mm, I saw it, but I'm not sure. Yeah, I don't see it. I don't see it. So let's just say if you take goods, instead of reducing the inventory, you will reduce your purchases. Okay, I'll explain that someday, inshallah. All right. Any drawings are debited in the drawings account. Now I was explaining this, right? Where is my 80,000 bank account? Too far. All right, let's just make another one. This is my bank account, and I have 80,000. I take 40,000, right? So, one second, I flipped it. This is the negative side, and this is the positive side. This is the debit side and this is the credit side. Any balance, like when you record anything on the debit side, it shows an increase in your bank account, right? Now I take 40,000 as drawings, and since it's coming on the credit side of the bank account, it will come on the debit side of my drawings account, right? Pretty much common sense. And what will I write? I will write bank. So you see that your drawings account, every time you take drawings of any kind, your drawings account will be debited because you're getting money into your drawings account, okay? The credit entry, sorry, to show the value going into that account, going into the drawings account. The credit entry will be the account giving the value. In this case, the bank account was giving 40,000 to the drawings account. So the bank account was credited and the drawings account was debited. All right, so credit the giver, the bank account is the giver, debit the receiver, the drawings account is receiving the money, we're debiting it, all right? When money is withdrawn, either the cash or bank account will be credited. When a non-current asset, the appropriate non-current asset. So let's just say that I told you, right, that in my business office, I like the furniture, and I was like, yeah, I'm taking this home. So I'm gonna have to take my fixtures and equipment account, and I'm gonna have to credit it and debit my drawings account with fixtures and equipment. Let's just write it like that. Okay, does that make sense? And then moving on, when goods are withdrawn, the purchases account will be credited. Now, why not inventory account? We have something as inventory account as well. Why are we, touching purchases? This is because these goods were originally purchased for resale. In your purchases account, you only have things that you purchase for resale, okay? You don't have your purchase of fixtures, or you don't have your purchase of your Bugatti or whatever. You only have purchases of the goods you buy for resale. Let's just say if you're a supermarket, then in your purchase account, you will only have your normal grocery stuff. This is because these goods were originally purchased. Okay, okay, okay. At the end of the financial year, the total of the drawings is transferred to the capital. All right. Why to the capital? Normally, the capital account was showing. I think we learned it in like chapter one. Capital, capital, capital. All right. So we learned that represents what the business owes the owner. So like the owner should receive this money back from the business, right? Maybe not today, maybe not tomorrow, but one day. Okay. So when you take drawings, the total amount the business has to pay you reduces. Before the business has to pay you 80,000. Now the business has to pay you only 40,000, right? This reduces the amount owed by the business to the owner of the business. Okay. State the name, it should be debited, it should be credited. Oh, this is kind of boring. Owner business invested more money into the business. So like since it's money, you're gonna have to debit bank. And since it's owner investing, you're gonna have to credit your capital. You're debiting the crediting the giver, debiting the receiver. Capital is giving money to your bank account. The owner of a business took an unused motor vehicle for personal use. Now they're trying to trick you here. They're saying unused, but it's still a motor vehicle part of the business, right? So your total motor vehicles are reducing, and your drawings are increasing. Credit the giver, debit the receiver. Your motor vehicles is the one giving the value to drawings account. Drawings is receiving money, right? Your total drawings are increasing. The owner took goods for personal use, so again credit purchases because your purchases are giving value, and debit the receiver, drawings is receiving the money. Very simple, very easy. When balancing account, okay. At the end of each month, it is usual to balance any accounts of assets and liabilities with more than one entry, okay. Now, since this capital account here, or let's just say this account here, has only one entry, this thing is an entry, okay, and this has multiple entries. Now, if we, oh, okay, if we total these sides, they will not be equal. You see, if you this side is $55,000 more than $55,000 less. Oh wait, it's the opposite. This side is more than $55,000 less. This side is less by this much amount. But when we close the account over here, they're closing it on a weekly basis, right? They're closing the account in the first week. This is called closing the account, all right? The balancing the account. When we balance the account, both sides have to be equal. Now, both sides are not equal, so you do something and you make them equal. What you do is you take balance CD. CD means carried down. So you carry this balance down from here. This side is 55 something greater. So you take this balance here and you're like, hey, come here for a while. All right, if this is going to be on the last day, like the day you're balancing the accounts, and you're going to be like, let's just carry you down, and you carry it down and you bring it down. This is balance brought down, and this is on the next day. So this poor balance stayed here for one entire day on the credit side. But next day he came here. Now remember that this one day does not make a difference or to anything, because like this is made on the last day and no transaction happens after this. This has to be the very last thing. Now let's just look at what they have to say. Steps to balance an account are as follows. Okay, whatever. Calculator or separate sheet, add up the side and find the difference. So over here, the difference was 55,395. Enter the difference on the next available line on the side which is the smaller in money. Over here, the capital side, this side is like 1995, 95,000 something, 95,095. Yeah, this side is greater and this side is lesser. So you have to put the remaining money, the difference, on the lesser side. And now they're both equal. All right. Enter the date, usually the last date of the month, but in this case, it's the last date of the week because they're asking us to balance after the first week. Okay, so it's like Jan 7. And then what do we have to do? Write the word balance CD. Yeah, but we don't need to do this. You don't need to do the folio column stuff. You just have to write balance CD, and this is the abbreviation for balance carried down. And then you just do balance BD again. That's the next step. To total each side, you just draw lines. So like one line and then double line. Double line represents that you're closing the account. No entry related to this month will happen after this. Anything that happens after this is for the next week. In this case, it's week. Normally it's year or month. Okay. Make the double entry for the balance carried down on the line below. Total, write the amount for the balance on the opposite side. Okay, so this was the side of balance CD, and this is the opposite side. This is going to be the balance BD, where the opposite side to balance CD, enter the date in the date column and the word balance BD, and this is balance brought down. So yeah, they pretty much, they said it's summarized, but it's very lengthy. Not summarized really. Okay, when balancing an account, add up each side and find the difference before drawing total lines and before writing the word balance. Yeah, wow. Okay, double entry for sales, purchases, and returns. So like sales returns and purchase returns both. You see there's double entry for literally everything, okay? Because that is important. Double entry is important. If you don't do double entry, you might in the end, like at the end of the year, you might be like, yo, where did all my money go? Because you didn't have proper records, okay. Necessary to open an account to record goods which are purchased for resale, and also an account to record goods which are sold by the business, right? Now if you say that, one second, so this is annoying me. Okay. All right. These are actually the same goods coming into the business and going out. So like if I buy $200 worth of goods, it means that I will also sell $200 worth of goods. So what's the point in making two different accounts? Why do you have to make a purchase account and sales account? It's because you don't sell them for $200. You only buy them for $200. You sell them for like, okay, this is annoying me very much. You sell them for a higher price, so you earn some profit, right? So let's just say you want to sell them for $300. That's why you need a separate account for sales. Uh, Purchase will be at cost price and sales at selling price. A purchase account and sales account are used rather than a goods account, because goods account will not be able to, have like different amounts. Yeah. An inventory account is only used to record the goods left at the end of the financial year and not for day-to-day transactions. Okay. This is why this question over here is answered that does drawings reduce inventory? Normally, yes, like according to common sense, yeah, it does reduce inventory, but you won't like write it in your inventory account. You will write it in your purchases account, and then whatever goods are left, they will, you're gonna do your inventory account stuff over there at the end of the year. Okay, because we don't want to make our inventory account crowded, we write everything in the purchase account, and then inventory account is just like the end. The same double entry applied to assets and liabilities is also applied to purchase and sales, which makes everything easier for us. Goods purchased for cash or check. Whenever you purchase something, purchase account will be debited as goods coming into the business. Purchases is receiving that value, right? So over here we have our bank account. Let's understand it from a different perspective. When you pay money, this is right plus here. Okay, when you pay money, your total bank balance reduces. Right now we're paying for purchases, so your purchases come on the credit side, and it reduces the bank balance. Let's just say we bought goods for 300 million. All right. Now, since it's coming on the credit side of your bank account, it's going to come on the debit side of your purchases account, and the detail will be bank, because bank is causing the purchases to happen, the purchase to increase, and you're going to write the same value here. All right. The double entry will be a credit in either the cash or bank account, a credit in either the cash or bank account, depending on whether the amount was paid by cash or by check. Very simple. Again, now let's just go for goods purchased on credit. What's the difference between goods purchased for cash or check and on credit? It's very much similar, but cash or check is paying right now and credit is paying later. Okay, so instead of, give me a second. Over here, we credited the bank account or cash account, right? Because they were the one giving the money, they were the one paying, they were the one reducing. In this case, we're gonna the purchase and everything will be debited in the usual way, but the credit entry will be made to the supplier because you have to show the value coming from that person. Now, yeah, for a basic level, this is a nice way to understand it, sure. But once you get ahead, you're gonna have to know that liabilities are like credit positive, and every time you credit a liability account, when you buy goods from somebody, they become a liability, right? They become your trade payables, and that's why every time you credit the liability account, you're increasing the value. So if you want to increase the value of your liability, you have to credit that account. But like, let's just not make it confusing. Let's keep it easy and simple. Let's just use this to show the goods value coming from that person. All right. Yeah. The supplier is known as a trade creditor or trade payables. Okay, because it's a liability, you have to pay them money. When the payment is made, the cash or bank will be credited and the account of the supplier will be debited. Now let's look at the example here to understand it better. Because I literally just read this, I didn't really explain it a lot. Ajay bought goods on credit means he didn't pay yet, so there will be no bank or cash involved. Instead, we will use Kolkata and Co. Kolkata. So 9 January, Ajay buys goods. The bank account is not involved yet. We go to purchases and we write Kolkata on the debit side because our purchases are increasing. And what's causing it to increase? Kolkata. So we credit Kolkata account because of double entry. If it's being debited here, it will be credited here. Okay. Like in Kolkata account, purchase will be credited. In purchase account, Kolkata will be debited. Very simple. Okay, wow. Now purchase happened, Kolkata gets credited, everything is nice. Like this was what exactly happened right in the first transaction. Go to the second one. Ajay bought 150 and paid by check, so your bank balance reduces by 150, so you credit bank by 150. And what causes it to reduce? Your purchases increase instead, right? So when your purchases are increasing, you're gonna have to debit it. Debit Credit the giver, the bank is giving money to who? The purchases. Debit the receiver. Very simple, very easy. Ajay paid the amount owing to Kolkata and Co. by check, so your bank balance reduces by, this was the amount, by 650. So when your bank balance reduces, you write it on the credit side, and this is it. On 13th January, we paid money 650, and what caused it to happen? Kolkata caused our balance to decrease. So the double entry would be Kolkata, credit the giver, debit the receiver, Kolkata is receiving the money, debit Kolkata, bank is giving the money, credit bank. Very simple, very easy. Alright, and then this is just the explanation, very cool. Only goods bought for resale are entered in the purchases account. I already mentioned this, but yeah. Now sales is very much similar, so let's just jump to the example. Okay. Ajay sold goods 175 for cash. What happens? Your cash increases. So your cash or bank, they have a cash account. Okay. Normally we have a cash book, but right now since it's basic, we're just gonna do a bank account separately and a cash account separately. Okay. Your cash is increasing, so debit cash, debit the receiver, and credit the giver. Who's causing the cash to increase? What is causing the cash to increase? Sales is giving money to cash, so you're debiting the receiver and you're crediting the giver. All right. Buy 175, and the detail is cash. We don't really have the name for this person, so we write cash only. Normally when you have a name, you write the name of the person and you make their own account like this. They have a separate account. Okay. Alright, we did this. Ajay sold goods on credit. Means he did not receive any money, so nothing is to be done with the bank account yet. 1 second. Okay. Alright. Sold goods for 770, so your sales increase and the amount you owe to the amount Prerna owes to you also increases. Now in this case, you see there is no giver and there is no receiver. Nobody is giving. Oh wait, sorry, we're giving the goods. Okay, that makes sense. But like, so there are some cases where there is no giver and there is no receiver. So this credit the giver, debit the receiver thing doesn't work. But I'll not explain it till like we actually have a case like that, right? Over here, our sales are increasing, so we credit the sales account and we debit Prerna because uh, she's receiving the goods, right? Debit the receiver, credit the giver, sales is giving the goods to Prerna, debit Prerna by 770. Next thing we have is Prerna gave Ajay a check for 500 on account. All right, I'm not sure what that means, but they have not said anything about discounts or anything, so we can't assume that, oh wait, it might mean that on account, like relating to the previous balances and everything. So well, we received 500 from bank on 28th to our bank from Prena. So we're gonna have to debit our bank account because it's increasing the balance. What's causing it to increase? Who's the giver? Prena's the giver, so credit Prena by 500, and the detail will be bank. Okay, very simple, very easy. Oh my god. Okay, wow. Anyway, the term on account, oh, they mentioned it, indicates that only part of the amount outstanding is being paid. The remainder will be paid at a later date. Okay, so like she owed 770 in total, but she only paid 500, and now she owes us 270. This is the point of balance BD, balance CD. Okay, you don't really have to sit up with a calculator and be like, okay, how much does this customer owe me now? Let's find out. But when you balance the account, that thing becomes easier for you. Okay, so like we made a sale of total 770 and we received 500, so of course we have 270 left and we bring that to the next month. Rena's account has been balanced following the stages mentioned previously, usually done at the end of the month. Rena is Ajay's debtor and an amount of 270 is owing to Ajay. Okay, debtor, sorry, what did I even say? Debtor. The heck? Okay. Rena is Ajay's debtor. Now, debtor means trade receivables. This is a different name. And creditor means trade payables. 270 is owing to Ajay. So Ajay will receive this money from Prena today or tomorrow or one day. And it's not guaranteed. Maybe Prena runs away with the money and doesn't pay it, but that's a different chapter. There's a whole chapter for that. Okay. And it's called irrecoverable debts. Now, sometimes goods have been purchased, have to be returned. these may be faulty, damaged, or whatever not ordered. Like let's just say you order something online and you go like, I don't like it, I want to return it. Okay. Now since you bought this, you purchased this thing yourself and you want to return it, it's purchase returns. Okay. And if you sold, like for example, for the supplier, he sold the goods to you and he's getting a return, so that's sales returns. Now you see they have a different word. Purchase returns is returned outwards because the goods go out of your business. Okay, so like you bought them, they came into your business, and when you return them, they go out of your business. Like they're not with you anymore, right? So it's a return outwards. And for sales, when you make sales, your goods go outside the business. But when somebody does a sales return, so like when you have sales returns, the goods come back into your business, and that's why it's returned inwards. Okay, so you open a different account for that, just sales returns account, and here also you open a purchase return account, and any returns are credited to the purchase account to show the value going out, because like you're not having that purchase in your business anymore, you're not having those goods in your business anymore. The debit entry will be made into the account of the supplier to show the value going to that person. How is that person getting value again? Are we paying him back? I don't know, I can't think. Anyway, yeah, that's the point. Return inwards is open and any returns debited to this account show the value coming in. So every time you have sales returns, your sales return account will be debited. Let's just say you have ABC or whatever, and you return. Oh wait, we have an example already. We can just look at this example and understand. I just sold goes to 45. So sales account is 245. Say we returned damaged goods 55 to Ajay. So we have another account, sales returns account, and it's 55. It's debited. Before sales was credited, right? And now sales returns is debited. So it's pretty much common sense, you know. Like if sales is being credited, then sales return will definitely be debited. Ajay purchased goods on credit from Varun 820. So you have again Varun. Here we purchased goods 820, and we have the purchase account, the double entry. And then say we paid their account by check, so you receive money in the bank account. In the bank account, you receive 190. Why do you not receive 245? We sold him goods for 245, but he returned goods. So if we go to save your account, we have a better, like we have a summary of everything that happened relating to him instead of running away everywhere. Okay. So we have sales of 245, and he returned goods, and then he paid for the amount remaining. So right now his account is closed. His account is balanced. 245, 245. It's balanced. There will be no balance BD or balance CD, right? Because there's no point. Okay. Next, Ajay gave Varun a check for 700 on account, which means he didn't pay the entire thing. So your bank balance reduces because you're giving a check over here, credit side, and it's 700. So Varun account is going to be on the debit side. You have your bank by 700. And now you can see that where did I say purchase returns? I think I skipped this. As you return 44, 40 goes 44 to Varun. So you have over here purchase returns, and you can see again the summary of this account. This is our supplier. We buy goods from him and we return some. We pay the money, and now we owe him this much. Okay, so this is a trade payable and it's a liability and it's credit positive. I think I'll someday explain that too. What I mean by credit positive and debit positive and that stuff. Purchase returns account. Over here it was Varun that was debited. So in purchase returns, Varun will be credited. Over here purchase returns was debited. And over here purchase returns is gonna be credited. Another way to remember it is like in your purchase account you debit everything. So in your purchase returns account you credit everything. Very simple. Now carriage is the cost of carrying or transporting goods. So let's just say you buy something online, and now carriage is going to be the delivery fees. Okay, so your carriage is your delivery fees. Carriage inwards is the amount of money you pay for goods to come into your business. So if I'm ordering something online and I pay delivery fees, then that's carriage inwards because I'm paying for the goods to come to me. When what's written here? When a business has to pay, okay, for when the goods have to be delivered to its premises, to the business's premises. Okay, so that's carriage inwards when the is the cost of bringing goods to the business, into the business. Carriage outward is the cost of delivering the goods to the customer. Yeah, sorry, customer. Now, why are we delivering goods to the customer? It's so the customer goes like, wow, what a nice guy, and he always buys from us. Okay, but we bear that cost because it's a selling expense. Because if we do this, the customer will probably buy from us again. And if we don't do this, the customer will be like, other people are doing this, I won't buy it from you. Because like they're gonna give me delivery too for free. Applying the double entry principle to carriage invoice, the carriage invoice is debited as this is an account receiving the money and the cash account is credited. Now, what exactly does this mean? Let's just say you have your bank account here. We can like link everything with your bank account because if you understand that better, you can understand everything else better. This is our bank account. This is the credit side. Okay, my handwriting's too good. I think I should reduce the size, change this. All right. Okay. So this is bank, this is the credit side, and this is the debit side. What happened? Yeah, you pay for delivery fees, you pay for carriage, so your total bank balance reduces. Let's just say you pay $20 and this is by carriage inwards. So in your carriage inwards account, you're gonna debit it and you're gonna write bank as a detail for $20. Okay, now let's read this statements again. Carriage inward is debited. Carriage inward is debited. Why? As this is the account receiving the money. So the bank account gave $20. The bank balance reduced by $20. Why? Because the money went to carriage inwards. So carriage inwards caused the bank to reduce by $20, and that's why you credit the giver, bank is giving the money, debit the receiver, carriage inwards is receiving the money. Alright, similarly, if payment relates to carriage outwards, the cash or bank account is again credited because your bank is giving money for your carriage inwards, and was good. Oh, you changed your name. I tried to ping you and all, but like, alright, good luck, we'll take care. Anyways, applying, yeah, over here, yeah, so your bank account is credited, your total bank balance reduces, and your carriage account is debited because it is the receiving side, it's receiving the money, and it's also because it's an expense. Expenses are debited. We learned that, right? We saw that. Where did we see that? Over here. You see, this is an expense, this is an expense, this is an expense. They are all debited. So all of your expenses are debited. Okay. All right. Moving on. You see how, like, in this subject, everything's very connected. So if you understand the basics, you understand everything else. Okay. Mm, if the carriage is not actually paid for at the time, the account of the supplier the carriage service will be credited instead of the cash or bank account. It's the same thing, like when you pay for goods and you don't when you buy goods and you don't pay for them, then you go to the supplier account. Then you go for the supplier account instead of bank or cash account. Okay. Explain how to balance a ledger account by just taking, like, let's just say this side is 20 and this side is 30. So you're gonna do 10 and this is gonna be your balance CV. This is gonna become 30 and this is also gonna become 30. And then you're gonna have balance BD here as 10. Yeah. Oh, pretty simple, right? Okay. Meaning of the term credit purchases means like buying goods and not paying right now, paying later. Two reasons why it may be necessary to return goods to a supplier. Maybe they're faulty or maybe they're not what you ordered. It's also written here. Returns. Maybe faulty, damaged, or not what was ordered. An alternative input says return inwards because the goods are coming into your business. Over here it says return inwards. Next, difference between carriage inwards, carriage outwards. Carriage inwards is for when you buy goods and you bring them into the business. Carriage outwards is for when you sell goods and you send them to the customer, delivering to the customer. Cost of delivering goods to the customer. Okay. Three column balance, three column running balance accounts. Now, right now we learned T accounts, right? We learned about this thing. And if you want to know how much, let's just say if you want to know how much you owe to Varun, You need to balance the account entirely, and now you know that, oh, I owe $76 to this guy, and I have to pay him someday, like someday soon, right? But there is a different type of, you know, keeping the account. There is this three-column running balance account, which shows you the balance after every single transaction. Okay, so over here, let's see our bank account. When we invest 80,000, our total bank balance over here, and at the end, our total bank balance is over here. So like at the start, we had 80,000 in our bank. Then once you pay your rent, your bank balance reduces. When you pay for fixtures, your bank balance reduces. This is like your new bank balance, new bank balance, new bank balance. This is you are getting the loan. So you see anything that's debited is increasing the bank balance, and anything that's credited is decreasing the bank balance. So the point of this method, this, 1 second, let's just read it, bro. The ledger account so far has been in the traditional form, which is the T account format, which is like this thing, it's a T. There is another method which is commonly used in computer generated accounts. So if you're actually going to like a shop or something, and you go like, give me your, like, get out of the counter, I want to see your accounting records, you're gonna see something like this, and you won't see your traditional key accounts. You're just gonna see this running balance format thingy. Okay, in a running balance format, they uses only one column for the date and one column for the details, and folio has three, whatever. One for debit, one for credit, and this folio, we don't really need folio. And honestly, you don't need to use this in the exam, you just need to know what it is, okay? So like they will ask questions for this, they might ask questions in MCQ and stuff, but you don't need to know how to make it. It's just fun to know because like it's too easy. Okay, and then this is the example, the normal bank balance that the bank account that we've been doing since like a very long time. And then, okay, last thing, I guess. All right. Interpreting ledger accounts and their balances necessary to understand the entries and to be able to explain those entries. The following account appeared in the ledger of HA. This is Xavier's Traders. Explain each entry and state with the double entry we found. Hmm. I'm not so sure about this, okay, but if you think that it's okay, then good luck. Because like most of the time the question will prepare the like already have the key account ready for you, and you're just gonna have to put the values in, like in your exams. That's how it's done. Anyway, back to the topic. I don't really feel like explaining each one of this. Okay, so this is balance BD. This is sales. When we see sales, we know that this guy is a customer, and when we see bank, we know that he's a credit customer. Oh wait, do we? Yeah, he's a credit customer. Anyways, all right. So what happened was 122. This is the amount he owes us. He owes us as like we are Ajay, and 122 we are the business, we are Ajay, and he owes us 122 for goods supplied on credit in the previous month. So like he bought goods, he didn't pay for them yet. Okay, oh, man, this is too lengthy. I want to finish chapter 3 as well in like 7 minutes. Okay, but this is pretty simple. Like it's just explaining it. You can read it probably. Oh, I forgot. I was supposed to increase the quality of the video recording when it will take effect next recording. That's kind of bad. Anyways, chapter 3, trial balance. We will skip this part. We will just go through this. We will just go through this. We will just go through this. A trial balance is a list of balances on the accounts in the ledger at a certain date. Makes absolutely no sense, but it will in a bit of time. Alright, a list of the balances on the accounts in the ledger at a certain date. Trial balance is prepared to check the arithmetical accuracy of the double entry bookkeeping. Now this statement, just memorize it, okay? Because like in MCQs, they'll use this word, and they'll ask questions on the accuracy, the what do you call it, the usage of a trial balance, and you have to say arithmetical accuracy, okay? The name of each account is listed in the trial balance. The balance of each account is shown by the debit balance or credit balance. So again, they also have a debit and credit side. Trial balance will show the total of the debit balance is equal to the total of the credit balance. Okay. If it's not, like if the trial balance, oh, wait, sorry. It's important to remember that trial balance is not part of a double entry system. It's simply a list of balances, and it's not even official. Like it's not a super duper cool official document. It's just something you do to check if your ledgers and if your double entry bookkeeping is all correct. Okay. If the ledger are balanced monthly, then a trial balance may also be drawn at the end of each month. At the end of each month, what do we know from this? We know that you can only make the trial balance when your accounts are balanced. Okay. A trial balance is a list of balances. It is not part of the double entry system. What does this mean? This trial balance, it's just your normal bank balances. So this was our bank balance at like 7th of January, right? At the last day. And this was our capital as well at the same date, 7th, 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 7th. Okay. So this is just the balance BD stuff at the last day. And you see the debit side is equal to the credit side. Now, if we did not do correct double entry, this would not work, okay? Because let's just say you wrote 95 in rent receivable side, okay, but you did not write it in your bank account. You did not increase your bank account by 95. It would mean that your bank account would be something like 55300, and that's why this would be 95000, and this would be 95095. So it would not balance, and you're going to be like, oh, I don't know, pulling your hair out mid exam. So instead of doing that, just make sure your double entry is correct and all. And trial balance is not even worth much, it's like worth 6 marks only. So it's kind of a scam because it's too easy and like it's a lot of writing and all. Anyways, trial balance. It should be headed with the term trial balance. Oh, by the way, I like to spell this as trial balance. Anyway, um, along with the date on which it was prepared. So like, let's just say 31st December. Okay, but in this case, in this example, it's at 7 January because these guys are doing weekly basis. I don't know why. I don't know who gave them the idea, but yeah. Oh well, actually, if they did a whole year basis, you would have to prepare like the accounts and everything for an entire year, which would be too difficult for chapter 2 and chapter 3. We don't have this in the later chapters as well. Anyway, all right. The purpose of a trial balance can help in locating arithmetical errors. However, balancing is not proof that the entries are completely free of errors. Okay, so if your trial balance does balance, it still does not mean that 100% there is no error. Okay, because there are types of errors which do not affect the trial balance. Like the trial balance can balance, but these errors will still exist. But we will not do them right now because like they're kind of difficult and they're like too lengthy and like it's too boring. You know, we'll do them someday. I like to procrastinate. Anyway, the preparation of a trial balance. All the ledger accounts which are open are listed together with the balance on each account. If the debit side is larger, whatever. So basically, what's happening here is that you have to balance the account. Okay, over here they're just showing that you have to balance the account. Let's just read it. All the ledger accounts which are open, those which still have an amount of money showing in the account, are listed together with the balance on each account. If the debit side if the debit side of the account is larger in money than the credit side, then the account has a debit balance. And if the debit side, whatever, oh, it comes in the debit column for trial balance, and if the credit side is greater, then the account has a credit balance and is entered in the credit column of a trial balance. Now, to understand this, let's look at the example. Where is it? But like, where are the accounts? Okay, over here. So you see this thing, 822 balance PD will come over here, 822. Okay, and you're gonna use Xavier traders on the debit side of your trial balance. Why? Because the debit side is greater. The debit side is greater by 822. So if you go to your trial balance, Xavier, where is Xavier? Oh, what? Am I blind? Okay, he's not here with me. Did I mix the example with something else? Let's just add, well, let's just look at the bank account 55395, and you see it's a debit balance, okay, which means that it comes on the debit side. If we look at the account example to help us understand better, I don't know where it's gone, bro. Okay, you see the balance BD is coming 55395 on the debit side of the account. Okay, so in your trial balance, you will also write on the debit side 55395 on the debit side of your trial balance, as you can see. Okay, so we learned from this that whatever side has the balance BD is gonna be the side of the trial balance. So if my account, X account has balance BD on the debit side and it's $1 million, then on your trial balance, it's gonna be $10 million, and your trial balance on the debit side also you will write 10 million. Okay. Okay. Moving on. All right. Prepare a trial balance, and this is the example trial balance. Bank is debited, capital is credited, fixtures and equipment is debited, loan is credited. Now, this is like, this makes no sense. How do I know what's credited and what's debited? So I used to use this mnemonic that our sir taught us, and it's pretty cool. There are multiple mnemonics out there, but I like this one. PEARLS. Okay, so this is for purchases, this is expenses, and this is assets. All right, and then this is revenue, which is like income. This is liabilities, and this is sales. Now, this does not include everything. For example, drawings. What about drawings? Where do they come? But it's good to understand. All right. Now, okay. So bank is coming on the debit side. Why? Because bank is an asset. Capital on the credit side. Why? Oops, it's not written here. But we're gonna use the accounting equation, and you can see that. All right. So capital comes on the credit side. Let's just keep it at that. I'll explain the accounting equation in deeper some other day, and it's gonna explain how this thing actually came to life, like how this makes sense and all. And the understanding the accounting equation in that way is way better than like looking at it in a mnemonic or something. But for now, we'll just use this and know that capital is always credit. So the capital will always have credit balance BD. If capital has negative balance BD, it means like, I don't know, it cannot be possible. All right. Fixtures and equipment, again an asset. Loan is a liability, or again, that's why it's credit. Motor vehicles asset. Malika loan liability. Rent payable is an expense. Expenses are debited. Insurance expense, motor expense. Rent receivable is part of revenue. It's part of an income. It's an income. It increases your profit. It's also sales. Like, it's in that category, right? So it comes on the credit side. Very simple, very easy. Explain what a trial balance is. Is like a list of balances, you know, yeah, it's literally that, a list of balances on the accounts in the ledger at a certain date. In the ledger basically means like in the accounting, I don't know, computer, something like that, at a certain date, as like in 31st of any month, or like 31st, or like the last day of the year. Okay, two purposes of preparing a trial balance, it's right here, one and two. Explain what determines whether the balance, okay, whichever side is greater. Explain what is indicated if the total of a trial balance agree that is arithmetically correct. If a trial balance, is it necessary to know the types which have a debit balance? Okay, now I used Pearls to explain what comes on the credit side and what comes on the debit side. But over here they have a table. Debit balances are assets, expenses, drawings. So like D for drawings, D for debit, purchases, and sales returns. Now, since sales is credited, sales returns will of course be debited. And since purchases is debited, purchase returns will of course be credited. Okay, so it's just gonna be the opposite. Capital is credited, C for capital, C for credit, D for drawings, D for debit. Very simple. Incomes, I said revenue, part of the mnemonic. Pearls, very simple, very easy. And then this is again An asset, so it's going to be debited. This is a liability, is going to be credited. Capital is credited. Drawings debited. This is an asset, is going to be debited. This is asset debited. This liability credited. This is asset debit. Purchase is also debited, like it's in nature. And then sales is also credited. It's like sales itself. If sales is credited, then sales return will of course be debited. If purchase is credit, if purchases are debited, then purchase return will of course be credited. Okay, wait, what? Purchases are debited, bro. What the? No way. They're doing something wrong. Was prepared by. Okay, yeah. See, I told you they're doing something wrong. So they have to. They're asking. Okay, well, they're asking us to find the errors and correct them. Okay, and contains errors. Now let's just look at the corrected answer and understand from here. Corrected trial balance, asset, liability, capital, drawings, asset, liability, asset, purchases is going to be debited, sales is going to be credited, sales return will be debited, and purchase return will be credited, carriage invoice is an expense, it will be debited, wages is an expense, it will be debited, net receivable is revenue or income, it will be credited, expense, it will be debited, trade receivable is an asset, it will be debited, and trade payables is a liability, it will be credited. And you can see everything is hopefully correct. And that way we have our trial balance balanced. And remember one thing, the opening inventory is included in trial balance. The closing inventory does not appear on the books when a trial balance is prepared, so cannot be included in a trial balance. Now, honestly, I did not know this. Like when I don't know, in my first year of accounting, or you could say like in a very, very long time, okay? And yeah, I used to make this mistake quite a lot, but alhamdulillah, I got to know about it, and I probably won't make this mistake again. At least I'll try not to. But it's a very stupid mistake to make, losing a mark is like that. The examiners must love annoying us. The heading of a trial balance was incorrect and required amending. Let's see what error the heading had. For the year ended 31st December 2009, trial balance at 31st December 2009. Because this trial balance is the list of balances at 31st December. It's not for the year, so like it has nothing to do with the year, you know. Like it has nothing to do with 31st April or something. I don't know. Is there 31st April? Anyways, each item had to be considered to decide whether it was in the correct column or not and required amending, but it was too easy for us. It's like, I don't know, it's just too easy. Okay, column which, whatever man, you can do this yourself. The trial balance and errors. That's, oh, we finished the entire chapter. Too easy. Okay, and yeah, next time we're gonna do double entry bookkeeping part B. Okay, anyways, so yeah, see you in the next class, I guess. Is it possible drawings is more than capital? I mean, why are you not opening a business if your drawings are more than your capital? So let's just say that you have invested a total of $50,000 into the business, okay? But that does not mean that your business only has $50,000. It could be possible that you took loan for $100 million, so now your business is worth 100 million plus, okay? And in this 100 million, you take drawings of $50 million, and your capital is still only 50,000. So your drawings are more than your capital. But this is not a very good thing. This is $100 million liability. This is very bad. Like you have to be, I don't know, very crazy to be able to do this, or you have to be very, very super self-confident and be like, I can turn this into profit. Just watch me. And there's gonna be like super duper crazy interest rates. But yeah, everything's possible. Crazy, right? Okay, I'll end the recording now. Bye.